Hey, Dan Passarelli here. Well, we had somewhat of a pullback today. S&P 500 down 2.2%. Is that the complete pullback that I was talking about a week or two ago? We'll see. I think there could still be some room to the downside. And in other news, we're going to keep an eye on GDP and PCE the next couple of days. But what I really want to talk about today is, could we be approaching a point where we might be able to find some bargains in some of these maybe overpriced high flyer tech/AI stocks? So I wanted to compare a couple of stocks here from a pure valuation standpoint. Let's start out with NVIDIA. So here's a 1-year chart of NVIDIA. And they're the one that everybody talks about, sort of the darling. And are they expensive? Well, how do you measure that? They were at 43 6 months ago, and they got up to 140 at one point. Now they're down to 117. Definitely a lot of volatility. Definitely a lot more expensive than they were 6 months ago. But the way we really measure valuation is in terms of what the price is compared to what the earnings are, the so-called PE ratio. Right now, the PE ratio of NVIDIA, and all this data, by the way, is from Thinkorswim, the PE ratio from NVIDIA is 51 compared with its 1-year average of 74. So it's actually gotten a great deal cheaper from a PE standpoint, but it's still 51. That means it's trading at a 51 multiple to earnings. Another one that we look at here is, people talk about TSM, Taiwan Semiconductor. Now that one, kind of same story, much more than doubled, and had a pretty good pullback here, about a 25% pullback. That one is trading at a P ratio of 158 versus its average of 115. By that metric, Taiwan Semiconductor is much, much more expensive than NVIDIA. How about one that people don't talk about as much, but is relevant, SMCI's super microcomputer, in a similar business. And by the way, all of these companies have somewhat of a different business model and focus on somewhat different areas and have a different story to them in the past, but they are all somewhat related. Now, this one, SMCI, geez Louise. I mean, if you want to go back 8 months or so, more than tripled at one point, or more than quadrupled at one point, pulled back, is coming up on not quite half of what its high was, had a great deal of volatility. Now that has PE ratio of 56 compared to its average of 22. So kind of comparable to NVIDIA as to where the PE ratio is now, but definitely above its average. And the final one I want to talk about is Intel, INTC. Now this is a much more storied one. In fact, if we go back on like a 3-year chart, we see a great deal of volatility. If we want to go back on like a 10-year chart, it tells a very different story than what something like SMCI does. Now that one is trading at a 46 PE ratio compared to its average of just 6. Now that's because that stock has had some trouble and was trading at a much more depressed price for a long time, and turned around its earnings a bit and improved its PE ratio and put it more in line with NVIDIA and SMCI, but is still the cheapest one from a PE standpoint of the 4. I hope that helps. This is Dan Passarelli, Trade Smart.